Even if you don't plan on visiting China for your next vacation, the recent depreciation of the Chinese yuan against other major currencies is important. So what's happened? This month, the Chinese central bank has changed policy. As a result, the yuan had its sharpest depreciation against other major currencies since the mid-1990s. The official explanation is that they want markets to influence the price of the yuan more, but the Chinese economy is also suffering from deteriorating growth and a stock market crash. A welcome effect of the depreciation of the yuan is therefore that it stimulates the economy through cheaper exports. Because of the depreciation, your made-in-China products will become cheaper. The other side of the coin is that business owners selling to China could see a negative effect on sales, as imports become more expensive for the Chinese.
So if we look at the recent export data for China, it marked a contraction of around 8%. So this kind of a depreciation would help China gain its export competitiveness and could spur exports for the Chinese economy.
China's exporters like supply chain middleman Li and Feng or iPhone assembler Foxconn will be the biggest beneficiaries. Rising wages in southern China have hurt factories there and caused many to move low-end production to countries in Southeast Asia like Vietnam. A cheaper currency could rev up those factories operating below peak production.
According to an analysis by The Guardian, New Zealand and Australia would be hit the hardest. In case of a near 15% drop in Chinese imports, the GDPs of New Zealand and Australia would drop by 1.9% and 1.7% respectively. Korea, which exports around a quarter of its outbound shipments to China, would be the third most affected country with a 1% decline in its GDP and a loss of almost $13.9 billion in exports. Although China imports the largest amount of goods from Korea, the proportion dropped by almost 1% from January to July.
In fact, a slowdown in the Chinese economy would imply a lower import demand from China itself. So countries that export to China, such as Australia, Korea and Brazil, would also need their currencies to depreciate in order to sustain their export growth.
Now, Friday, the Feds announced that China is selling $366 billion more merchandise to we Americans than we Americans sell back to the Chinese. $366 billion trade gap. Specifically, how will you fix that?
You know, this is my big point. I've been talking about it for years.
I know, but I want to know how you're going to do it.
The number's actually higher than that. Well, listen to me. I'll tell you, okay? We are going to have to go. One of the reasons they're able to do it is they devalue their currency to such an extent. They are the single greatest currency manipulator that's ever been on this planet. And if they don't stop devaluing, we're going to have to charge them a tax on the goods coming in. They, by the way, Bill, just in case you don't know it, they tax our goods going into China. It's a totally unfair deal. And what's happened, every time they devalue their currency, they make it impossible and more difficult for our businesses to deal with China on the other side. The gap is getting bigger and bigger. It's really called the deficit. The deficit is getting bigger and bigger. And unless we have somebody very smart and very tough that understands it, and our president does not understand it, but I understand it better than anybody, we're going to have nothing but trouble.
So you're going to...
Well, the U.S. has called for a 256% tax on imports of steel from China. That's after a U.S. Department of Commerce investigation found that corrosion-resistant steel products from the country were produced at unfairly low prices. The investigation follows complaints from 6 American steelmakers, including U.S. Steel, who said the imports were harming domestic companies. Reports say that U.S. steel mills have slowed by as much as 38% of their capacity due to rising imports. Furthermore, the industry benchmark hot-rolled steel coil, which is used in everything from fridges to freight containers, plunged 40% in 2015. The U.S. call for higher tariffs comes just a week after Mexico launched its own anti-dumping investigation on imports of Chinese steel products. This week, China